Good morning, everybody, and welcome to another Hamilton Wealth Partners Fund Manager webinar. My name is Kane Barano, and I'm a principal at Hamilton Wealth Partners. Now, I know I said our last webinar would be the final one for 2020. However, we wanted to squeeze one final webinar in to ensure clients had the opportunity to hear from Cooper investors about their family and founders fund, which will be reopening to investors early next year. So the format for today's webinar will be the same as previous webinars. I'll begin by reading a brief advice warning. I'll then introduce our guest speakers and I'll hand over for about 25 minutes of presentation. We'll open up for questions at the end. However, do feel free to submit any questions you have in the taskbar below throughout the webinar. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation or needs. You should, before you make any decisions regarding any information, strategies or products mentioned in this webinar, consult your advisor to consider whether that is appropriate having regard to your objectives, financial situation and needs. So today I'll be joined by Peter Cooper, Allan Goldstein and Marcus Guzzardi from Cooper Investors. So Peter Cooper is the Chairman and Chief Investment Officer of Cooper Investors, as well as the Portfolio Manager of the Cooper Investors Brunswick Fund. Peter founded Cooper Investors in 2001. As Chief Investment Officer, Peter created and implemented the firm's VOF investment philosophy, which is applied across the international, domestic and Asian equities strategies. He is responsible for mentoring investment team members and for the standardisation and integration of the process across the investment teams. Peter has over 30 years of investment management experience. In 1989, he joined the New South Wales State Superannuation Investment and Management Corporation as a specialist industry analyst and progressed to deputy portfolio manager of the $7 billion portfolio. In 1993, Peter ran the Australian equities portfolio for BNP and then joined Merrill Lynch Investment Managers, formerly known as Mercury Asset Management, where he worked for 7 years, culminating in his position as head of Australian equities and managing director, where he oversaw a team managing $7.5 billion in Australian equities. Today, we'll also be joined by Allan Goldstein, who is the portfolio manager of the Cooper Investors Global Equities Fund. Allan joined Cooper Investors in 2007 and has over 12 years of experience investing in international equity markets. Having been a foundation member of the Cooper Investors Global Equities team, Allan has been instrumental in refining and implementing the VOF investment philosophy and the Cooper Investors way in global equities markets. This has enabled the team to deliver consistent performance and to build the global equities platform to over $2 billion in assets under management. Allan was also appointed portfolio manager in 2011 and today specializes in North American markets. Our final speaker for today is Marcus Guzzardi. Marcus is co-head of Americas for the Cooper Investors Global Equities Fund. Marcus joined Cooper Investors in November 2012 and is a member of the Global Equities team. He focuses primarily on North American companies. Prior to joining Cooper Investors, he began his career in 2009 as an equities analyst at Diogene Research, an independent equities research house. At Diogenes, Marcus was responsible for financial quality analysis of companies and industries in Australian and international markets. So with those introductions, I'd like to hand over to Peter to first provide some background on Cooper Investors.
Thank you, Kane, for that very comprehensive rundown of Cooper Investors. So it'll enable me to keep my introduction succinct and relatively brief. The thing that fascinates us about investing is the systems and patterns that sit behind stocks, and we only do one thing only, that is long only listed company investing. So we don't do any shorting or hedging other than some currency hedging, no leveraging in the portfolio. So we're really dedicated, I guess, our investing disciplines to one part of the asset allocation pie, that is listed public market investing. But in the last couple of months, we've completed very proudly, this is an internal document called the CI Way, and it's a money management system, about 180 pages, compilation of all the, I guess, internal work and case studies that we've developed around both qualitative and quantitative aspects of our investment philosophy. And I'm proud to say that this book is a composition of lots of the homegrown talent like Allan and Marcus Guzzardi on the call today have really developed, I guess, some of the experiences and ideas that I started the firm with back 19 years ago, but I can tell you it's 100 times better than what it was on day one. We've remained very consistent with the philosophy. And in terms of, I guess, my prior experiences, both in investment management, working for three global investment management organisations, Mercury, Merrill Lynch and Banque Nationale de Paris, we've been able to sort of develop our own expression of value investing. We call it VOF, value latency, operating trends and focused management behaviour. But it's really the qualitative nuances and development and the strategy that we've applied to developing this investment philosophy. And there's a couple of things that I just want to call out. First of all, whilst we're a value and qualitative first organisation, and what I mean by that is the 1,500 visits a year we do, you know, we're garnering so much information that you won't find in annual reports around industry and company dynamics and human capital in the firms that we invest in. It's incredibly rich with information, but we've taken a very, I guess, disciplined and rigorous approach to it. So we've codified and standardized so much of the information that all of our fund managers do across those, you know, research questions and the 1,500 visits that we do every year. And that standardization is incredibly important in a global organization, because what it does is allows the transmission and transference of ideas and information and the building of both internal and external relationships. And from that integration, you can then go to what we call domain expertise. And one of the areas of domain expertise that we've developed over the last 19 years is family and founder investing. It's incredibly rich in terms of opportunity. Allan first came to me with the idea, because we've been investing in these types of companies both in Australia and overseas for the past 19 years, and said, this is such a great source of value for our organisation. Why don't we set up an individual fund called the Family and Founders? So it's not a tack-on fund. It's really at the heart of our investing style. We have a very big focus on proprietorial investment or proprietorial management is what we're looking for. People who really care about the way capital is organised and allocated within companies. We've categorised under the heading of focused management behaviour 3 types of management teams with different genres and different positives and negatives, if you like. One of those categories is the family and founder category. The first time I came across this, I guess, phenomena of family and founder was my own family. Came from without going too deeply into it, from a New Zealand agricultural family, built up a very large unlisted public company called Cooper Seeds back in the 1830s. It was started. Long story short, by 1970, after 160 years of successful business, it was all over Red Rover. So join the sad story of first generation makes it, second generation grows it, and the third and fourth blow it. And my father came to this country without any inheritance or the trappings of a well-off family, and was a small business person over his career. And so really have felt and seen, and I know Allan also from a small business family, this idea of family and business life being incredibly integrated is something that runs very deeply through our veins. I also had the opportunity to work as a research analyst at the University of New England for a couple of years in a for-profit sort of adjacent enterprise to the accounting department, which studied small business in this country. And we used to work with a number of the business associations, like the Hardware Association was the one that I remember. And we used to run financial surveys around Australia to really analyse the best of breed, and then organise workshops back in the days when people came for 1-week residential workshops in Armidale, New South Wales. And it was there I got to see both the data, if you like, the financial data that demarcate and discriminated the top quintile from the bottom quintile performers. It wasn't so much the data that was compelling, it was the stories and the software and the culture in spending a week with both the top end operators and the bottom end operators, where it became really obvious around the passion and the disciplines around curiosity and innovation and communication and business strategy, if you like, even at the small business end, of employees up to 50 or so, that really got me kind of interested in this idea of both qualitative and quantitative assessment. And it was also the origins of something that underpins our investment philosophy of observation, not prediction. It's when you get to see these companies at what we used to say the coalface of industry, or now we call it on the wind blades of industry, that you really get to see the top operators and what they really look like. And it was the CI way cover of this book that Allan came to me raving about this company called Danaher, one of our founder-led companies. It's now kicked on. We've been invested in that company for 10 years, been a now $130 billion fantastic company. And they had a manual called the Danaher Way. And so it was through those conversations with Allan that we decided to get our own little operating manual going. But these proprietorial driven family companies are just amazing, and they really distinguish themselves from the average institutional company. So I'm very proud to announce that we're going to open up this fund for a short period of time before we close it to new money. Today, the CI business is fully integrated across 7 odd funds. We've got a short list of companies that we track really closely around the world, around 450 companies that sit on our research platform. It means we model these companies, we visit these companies one-on-one, not broker conferences. We love to go to their offices. Been interrupted in the last 9 months, but we're championing at the bit to get out there again. And it's a testament to the relationships, particularly from the global fund, that we've built over the last, particularly the last 12 years, that frankly, we haven't missed a beat through COVID. Zoom's not quite as good as the face-to-face, but we've been getting access to all of these companies around the world. And it's because we've positioned ourselves as long-term capital investors, enduring investors, and I think the 100% employee-owned ownership structure of Cooper Investors. We've got 13 equity owners and partners in the business that really have set us up very, very nicely to really build out this network of founder and family companies. So no further from me. We can take some questions at the end of the presentation, but over to you, Allan and Marcus.
Thanks, Peter, and thanks for having us, Kane. It's great to be here. And so Peter's given you an overview of the firm. I'm going to explain the context and the overarching strategy of the Family and Founder Fund, or FNF for shorthand. And after that, Marcus will then run through the portfolio in some more detail and highlight some of the key attributes of the fund itself and the stocks in there. But continuing on what Peter talked about, the concept of a distinct FNF fund, it's been in the works for a long time. It's an evolution of everything we've been doing and even what Peter's been doing before CI. Proprietorship management and cultures, investing alongside those families and founders. And it's 30 years for Peter, 20 years for Cooper Investors, and 10 to 15 years for the global equity side of the business. And so for those that aren't as familiar with our flagship global fund, we're really leveraging the work that we've already done as an organisation. So that's a 40 stock portfolio, stocks all around the world, investing in large caps and mid caps, those under the radar companies below the $1 trillion levels, those FANGs. And this is a fund that's delivered above 14% per annum returns over the last 10 years. And our process for building that fund has been analysing and bucketing those companies into 3 different management groups, as Pete said. And the first bucket, owner-operator cultures. You think of, in Australia, a CSL, a Macquarie, overseas a Costco, those unique cultures that are run like founder-led businesses. There's also specialist focused management, companies where new management go in. Peter talked about our networks, the relationships we've got with management, how we can follow in. Lifestyle communities in the Brunswick Fund has been a great example of that. This FNF fund that we've set up now is all about only investing in that one bucket, that third bucket being founder and family-led companies. And ability to buy those ones we've been tracking for a long time, and given it's a bit of a smaller portfolio, to buy some of the next generation emerging family and founder-led companies, the next global franchises earlier on. So this strategy, all about applying our VOF process to this unique subset, trying to find founder-led companies, family-linked companies, or employee-owned companies. And it's our own qualitative analysis in how we determine that. We're looking for both the material and absolute levels of ownership, which we'll get into in some more detail, but also the qualitative side. Everything we do has a really important qualitative overlay. So it's not a box-ticking exercise. We're finding those companies we've got strong relationships with and backing those management teams. So this fund is for those people and those investors that truly believe in the power of this dynamic and want this pure play experience. And over the last 10 plus years, we've been investing internationally. We've been uncovering more and more of these types of companies. There's not many out there, but we're now at a place where a third of that flagship fund are these family and founder type companies, and there's many more on the watch list. So we now have the scale to have, and the opportunity set to have this unique concentrated portfolio. There's not many great opportunities available in this space. So it's not going to be a 50 stock portfolio, but we're very comfortable running a 20-odd stock portfolio in these because when they work, they're such powerful compounders and such powerful opportunities for the long term. So we thought this would be an attractive opportunity to pursue, and one bit of feedback we'd been receiving from a number of clients, in particular business owners, family offices, was can they just invest in those types of companies? So there was an alignment there that we'd been hearing about anyway, and no surprises that when we opened the fund up for a short period last year, they were our core investors. And so we seeded this fund on the 1st of July 2019, our own staff money. Soon after, some clients started asking if they could join us on this journey. And so at the end of the year, last year, we opened up the fund. We had $100 million come in, and 2020 was all about focusing on investing and delivering on the opportunity set we saw. Staff as a group are the largest investor in the fund today, and even after this raising, staff will continue to be one of the largest, if not the largest investor as its own group. The importance of that insider ownership, as I'm sure you will gather. So backing founder-led businesses has become a bit more popular in the media. It's become a bit more zeitgeist, but for us that have been looking and analysing and investing this way for decades, what is so special about this dynamic? On the next slide, we highlight 3 things that we point to that drive this advantage. You hear us talk a lot about observation, not prediction, and about pattern recognition. With these companies, there's a mindset which drives those right behaviours and therefore the long-term and enduring shareholder returns. So firstly, long-term thinking. That is becoming an increasingly rare construct in markets. The average tenure of a CEO is less and less and less. It's less than 5 years now, going 4.5, and it's trending towards 4. How can you build a business when the focus is on 3 years of cost cuts or buybacks? Just a complete different mindset in how our family and founder run companies go about building businesses over decades. The next one we have there is skin in the game. And the great Charlie Munger quote says, "Show me the incentives and I'll show you the behaviours." Our portfolio has 20% insider ownership levels on average, so a big number. I'd like to remind people the story of the previous GE CEO, Jeff Immelt, that was sacked after 15 years in the role. Not only did he have his own private jet, but it came out he always had a second one following him in case something happened to the first. You're not going to do those things when it's your own money. There's a lot of skin in the game for our owners and operators, and it means something. But one thing I think people overestimate is just the monetary drivers itself. It's really important, but it's not everything, which leads us to the most important, but also the hardest piece to judge, which is the soul in the game. And this is where our relationships and our qualitative assessment really comes into the investment process. How engaged are the owners and management in the company? Is this really all they care about? Is the business what they think about when they go to bed at night and wake up in the morning? What we're trying to find is a portfolio where those founders or that family are still walking the facilities, still know their employees, are still heavily engaged in running this business like they have been before, not just collecting checks from the family company. And in a practical sense, what this looks like is, Pete mentioned Danaher. This was founded by two brothers 35 years ago, and they've turned a boring old industrial business into what is today one of the world's leading diagnostics and life sciences companies. That 30 years later, despite being worth $10 billion each, they're still sitting down with the managements of their businesses all the time, spending the time to get to know them, involved in deciding who's going to be promoted next, learning about the trends in the business, helping these people run the business. That's what the founder and family involvement looks like as wealth generates. So our own experience, as well as academic research, says this is an outperforming area. You know, there's the Credit Suisse research, there's a whole number of areas, there's our own anecdotes. But one thing we've found, and one thing many investors actually raise with us, is all the bad stories in this space. Just the way and the amount of times insiders have, you know, taken minorities for a ride. Family and founders, they come with different dynamics, different levels of issues. And some are similar that you want to watch out for, the way they can manipulate their businesses to favour them versus minorities and things like that. And some of the clear examples that come to mind is, you know, the founders, the corporate raiders of the 80s, just putting leverage on leverage on leverage and acquiring with very small initial stakes in a business, control and running amok. And, you know, it turned out most of them were outright crooks at the end of the day. You know, a major pitfall you want to avoid. In the family side, the Cadbury company, you know, after generations and generations, that family just lost touch with the company. They were running it as a family company, and after decades of underperformance and disappointing performance, the company was eventually sold away. So there are a number of things you have to watch out. But at the high level, what's exciting is we know this is an outperforming area. We know where things can go wrong. And with our VOF process and stick with those high-ranking companies, we can make really attractive returns over the long term. So before I hand over to Marcus, here are some of the high-level characteristics of the portfolio. They hopefully provide some insight into the exposures. So it's large caps, but still on the smaller end of the large caps, mid caps with a few $1 to $2 billion opportunities that we see. In terms of regional exposures, we get, when people look at that slide, the one question we always get is, why Canada? That looks like a bigger weight. And the answer to that is, these aren't Canadian companies, and it's just like many of the things we're doing. These are global businesses that just so happen to be there. And us as Australian-based investors, there's a real cultural alignment with Canadian businesses, the risk reward, the values, but they've had the experience and the success of, with the US being on their borders, competition coming in, expanding into new markets. So these are all global businesses that just so happen to be listed in that market and have been a good source of outperformance for this portfolio since we started. Before I hand it over to Marcus, what I want to just leave with is that despite all the ups and downs and ups again of 2020, it's been a great opportunity to see the FNF type management teams prove themselves out again. I think if you would have told me and Marcus in July 2019 when we're starting this portfolio that there'd be a pandemic coming the following year, I think we would have avoided starting a new fund and let that one go through to the keeper. But it's been a great experience because that time period saw what these companies do. these management teams flipped into gear. They saw the opportunities, they cut costs, but they stood by employees, they stood by investment, they cut unnecessary costs, travel, marketing, things they didn't need that were important to run this business, but while looking after the core of the franchise. An example I want to tell you about is Colliers. This is the global real estate services company. The CEO bought this business nearly 20 years ago. And he spent the last 20 years building out this business for exactly today. This was a brokerage business, transactions, buying and selling buildings and leasing. But that's less than half the business today. He's built out a recurring revenue property services business in alternative investment management, property valuation, advisory services, where this year the company is barely going to feel the pain of COVID despite being one of the more cyclical businesses, and its stock is up about 20% this year as they've proven out the business model throughout this cycle. So we saw these companies get through the most difficult of periods, and now we're seeing them shift to an offensive mindset. How are they going to take share? Where are they growing next? Who to hire? What opportunities to buy? And that's really the exciting part of the journey that we're on now as we enter into the next few years. And on that note, I'll leave it to Marcus to run through the portfolio itself in a bit more detail.
Thanks, Al. So Pete's given you an introduction to the firm and our philosophy, and Al sort of brought that to life in terms of how it really applies to the FNF portfolio and why we're so excited about it. But hopefully what came across is the really qualitative-led investment approach that we apply at Cooper Investors. But that's not to say that we ignore the numbers and things that can be measured. So I thought I'd give everyone a little bit of an overview of what the portfolio looks like when it comes together, and some of the numbers and I guess quantitative aspects that come along with that. So first off, touching on diversification, obviously very, very important. This is a concentrated portfolio. We expect the portfolio to hold roughly around 20 stocks for most of the time. So we have to be very mindful that we're not creating any other concentration levels that we're unaware of. And so we're very conscious of making sure that we're diversified by industry. You should be able to see from that pie chart there, if you did a quick count, you won't quite get to 20 stocks, 20 industries, but it'll be pretty close. Other things that's very important to take away from this pie chart is technology. Now, technology is a huge area of focus for the market and has been a big driver of returns, and if not returns, then Inc. In the Wall Street Journal and the AFR. And technology does play a role in this portfolio, but really want to stress that it's just one part of the portfolio. There's much more breadth to the type of industries that we're looking to invest in here. I mean, we've got industrial companies like Fortive, financial exchanges like the Intercontinental Exchange, retirement communities like Equity Lifestyle Properties. And the outworking of that is that we think it has and will continue to drive a real stability to the returns that we're going to be able to deliver for our investors. For example, over the last 12 months, most of our better performers haven't been the technology names that we've been invested in. I mean, they've done fine, but our better names include businesses like Danaher. You've heard that name a couple of times today. They're in healthcare and life sciences, or First Service. They're in property services. A couple of businesses that are, a long way away from some of those technology names in terms of what they do and what, the papers will believe have been driving returns. Another way that we like to think about the portfolio and diversification is subsets of value. These are how we assess all of our investment propositions and investments here at Cooper Investors. And the names there are reasonably self-explanatory. I won't go into a lot of detail on them now, but safe to say, Pete waved the book at the start of the presentation. There's a huge chapter in there on all the things we're looking for and codifying what it actually means for a business to be classified as a stalwart or a growth company or an asset play, etc. Now, the breakdown that you see here, that is pretty typical of a CI portfolio. So the majority of the fund invested in those stalwarts and growth companies that provide that sort of nice sort of compounding and steady profile to the returns that we hope to deliver. And then another piece, which, call it roughly a third, a little bit less at the moment for the FNF fund, but sitting in those other categories being asset plays, bond-like equities, and cyclicals. And we allocate capital there when we can identify value latency. Again, another thing I think worth highlighting is that whilst growth is certainly a part of this portfolio, it's not the only driver of returns. I mean, we've had some of our growth stocks do really well. Tectonic Industries, the owner of Milwaukee Tools, they've had a really fantastic year as all the home renovations and people investing money in their homes with work from home has seen demand for their products, accelerate. But one of our other, best performing stocks for the past year has been Franco-Nevada. They're an asset play. They own a portfolio of gold royalties. And again, just really wanted to drive home the fact that where we get our returns and where we can deliver those returns for our investors comes across the spectrum of this subset of value, of these subsets of value. Next, just wanted to quickly touch on the financial profile of the fund. Like I said, we are qualitative-led investors, but we certainly don't ignore the numbers. Any number that appears in a 10K or an annual report, within a matter of seconds, it's probably in an algorithm being traded somewhere. So when we look and think about the numbers, we have to apply the FNF lens to understand, track records and patterns and what that likely means for future value creation. So what we've done here, pretty simple, we've selected a bunch of financial metrics and compared how the FNF fund stacks up on these metrics to the S&P 500. We just used the S&P 500 because we can get a bit better data than sort of the broad MSCI index. But I just want to reiterate, this isn't a US fund, it's a global index. The S&P is probably a bit of a higher benchmark on some of these metrics anyway. So the first table is pretty simple. We've got organic growth, operating profit margin and earnings growth. And you can see here that the FNF fund is clearly superior on those key growth and margins metrics. This gets back to the core of the VOF investment process. We're looking for businesses that are enjoying positive industry trends. So things like life sciences, vertical market software. I mentioned retirement communities with the growing or retiring baby boomer generation. We can see sustained growth there for many decades to come. But the second table there, and I'll go through those metrics and how they fit together. We think when you take them together, they really tell an interesting and important story that's very, very underappreciated by the market. So the first line there, net debt to EBITDA. That's just a measure of balance sheet strength. So lower is better in this instance. And you can see the FNF fund is carrying almost half the gearing of the broader S&P 500 index. And that speaks to the type of people that are running these businesses. They're not out to optimize capital structures and minimize WACC. They want to have balance sheet latency. They want to make sure that their business can survive through any type of crisis. And we saw it this year. Al mentioned some of the businesses that were able to already inflect into positive or offensive moves in terms of investing and making acquisitions, while some of their peers were stuck scrambling to refinance things with the banks. Next one, free cash flow margin. We've got a pretty simple philosophy here at Cooper Investors when it comes to earnings quality. And you can't buy a sausage roll with $3 million in accounting profits. You need $3 in cash. And our FNF companies, they convert their free cash flow at over 100% from accounting profits, versus the S&P at just 3/4 of accounting profits into free cash flow on average. And that's how the stewards of these capitals run their businesses. You think, how they measure themselves is cash in and cash out. How much cash did I generate for the year? They don't really care what the accounting boffins said that they made over a 12-month period. That's how all business owners tend to run, and that pervades even with these larger listed companies. The next line, returns. Again, this speaks to the quality of the businesses and the people running them. Our FNF companies generate higher returns than the S&P more broadly, despite carrying less debt. So ROE can be boosted by carrying more debt, but even despite carrying less debt, our FNF companies generate those higher returns. And then that last line there, the percentage of free cash flow returned to shareholders. So the average S&P 500 company, they're returning 3/4 of their free cash flow to shareholders through dividends and buybacks, whereas our companies in the FNF fund, they're keeping about half. So what are they doing with that other half? Well, they use it for capital allocation, and most prominently, once they've invested in the business, and you can see with the growth and margin profile that they're doing that, it gets deployed into M&A. Now, we are certainly believers in the literature out there that suggests and proves that most M&A fails to create value. In fact, it actually destroys value. And when you think about it, that makes a lot of sense. I mean, M&A is really difficult. The timeline to consummate a very successful acquisition might be, a couple of years of analysing the industry landscape, identifying the target, negotiating with the company, executing the acquisition, the synergies, and then really, extracting all those synergistic and strategic benefits that you thought were available. Think about how long that might take, 3, 4, 5 years. Allan said earlier that the typical corporate CEO is trending towards, 4, if not 5 years as their average tenure. It's just not long enough to really extract the value. Contrast that to the FNF companies. They're there for decades, if not longer. They understand their industries better than everyone. They likely disrupted the industry in terms of creating and building the business, or they were talking about it around the kitchen table from when they were young. They have an intimate understanding of where the value can be created in their industries and where the most attractive M&A opportunities are out there. And this is a chronically underappreciated and misunderstood element of these FNF companies, and what we believe will continue to be a substantial driver of value creation for the companies that we are investing in this FNF fund. So to summarize, Pete went back to, I think we started the introduction talking about Pete's days at New South Wales Super and his lessons there. So it's been a long journey to conceive and deliver this fund, but in many ways it does feel very natural for us at Cooper Investors. We're just extending and focusing on what we've observed as being, such an attractive place for us to invest and what works for us. We're applying that VOF investment process to build a well-diversified portfolio of these unique FNF sold in the game type companies with a financial profile that we think will continue to create significant value. And that's why we believe this product is, this fund provides us with a compelling platform to deliver attractive returns to our investors. So I think with that, I'll hand it back to Kane and Pete and Allan, and we're happy to take Q&A.
Great. Thank you very much, Peter, Allan, and Marcus. That was great. We've got one question that's come through already from Michael. So he's asked, do you foresee that over time, more family and founder, I believe he's companies will find their way into the broader Cooper Investor funds? And if that occurs, how do you foresee that you'll manage that?
Well, the beauty is that we've been investing in these companies. All our funds have had a meaningful portion of their investments in these types of companies, and so it has been a feature of all our funds. Peter, is it right that almost 50% of Brunswick Fund is family or founder-linked companies,
Correct.
Domestic and global? And that's at the high end for the other funds, but yeah, it is a feature of all other funds. But it's like what's been interesting. It's like if you buy a red car, all of a sudden you notice all the other red cars on the road. So having a dedicated fund and having that lens, it's just further helps build out the opportunity set. You're moving more and more in those circles, and these companies were already huge idea generators for us. We've talked about Danaher for a bit, but the amount of investments that have come off the back of that. We've talked about Collier's. We own a sister company of theirs as well in the portfolio. So the beauty of these types of businesses is the follow-on idea generation, full stop, because they're looking to deploy capital into attractive markets, and they're looking to hire good people or invest in good people, and that's what we're doing. So we can sit down with them and find out what they find interesting and what they're wanting to do, and do our research into those own markets and those companies. And so it's been a great idea generator, staying close to these types of people.
Great, thank you very much. Now, Allan, you touched on some of the pitfalls of family and founder-led companies. One of the criticisms of many companies with a dominant founder or controlling shareholder is that their interests can sometimes be ahead of minority shareholders. How do you filter for this, and how do you control for this?
So a real huge part of our process is building relationships with the companies, our own qualitative assessment of the people. So all of us on the investment team spend 2-3 months of the year overseas. We're going to see them in their facilities. We didn't put up a slide, but in one of our slide decks, we've got a slide of the old European family-linked companies, the ones that have been around for 100 years. And their offices are probably the best real estate in top European cities. And those offices look like a homage to what they've done previously. They're the nicest offices, but they're looking backwards. They're not looking forwards. You know, they can be lifestyle companies. They've got great assets, but we're about spending time with the management, the operators of these companies, and holding them to account. So we go back and we chat to them every 6 months and try to understand, what are they doing? The broader research is obviously important too. So the structures, are they holding super voting shares, analysing some, you know, are they leasing properties to the company? That's always an interesting one. And we do our due diligence. We speak to former employees. We speak to customers, competitors, to really build a complete view of who these people are.
Great, thank you. Here's another question. If other Cooper Investors funds are already heavily in founder and family-led companies, why would investors want to limit their investment opportunity set to such a narrower theme?
It's for those individuals that really believe in the power of this and have both the interest and the capability to ignore what else is happening in the markets and just focus on these opportunities. I think Marcus has showed on some of his slides that there's a broad opportunity set. The different types of businesses we can own are quite large and some really great businesses. So we don't see that we're you know, you're limiting yourself, but it's for people that really believe in that long-term nature and the power of that stewardship. And I'm sure one of the others also have their own passionate views on why this is appropriate.
I think the other, this is just really an internal conversation that we often explore around private and public capital markets. And, you know, sort of, I'm sure many of your clients are invested in private equity, and there are just some phenomenal private equity sort of opportunities and firms out there, but most are not. And I think, you know, what we see, I guess, in these companies is our version of, albeit public company, you know, private capital kind of expression, with a couple of key differences. One, these are not leveraged companies. These are generating high rates of return without leverage. And secondly, I would say, you know, benchmarked against the average private equity, these guys are just far superior in terms of industry depth and knowledge and nuanced knowledge that can add value in very sort of niche but big markets. So they're actually adding most of their value through sort of strategic and operational knowledge, not sort of financial sort of structuring and leverage. So, you know, we're and as I said, you know, we've got just endless examples in terms of this being a, you know, really wonderful source of industry knowledge for us as an organisation. We just felt it was worthy of, I guess, its own category. And, you know, we'd love you guys to invest in all of our funds. So, you know, it's up to, you know, as many of us are, and it's really just designed, and this is why we want to keep it limited capital. And whilst there's lots of family orientated companies, as you said, Kane, there's lots of reasons not to own some of these companies, and that's the work that we do in our research and sifting through. And so, you know, we're tracking very closely, you know, I think Allan's, you know, 50-60 odd companies, and whilst that's likely to grow, you know, we're also dropping companies from our bench. So yeah, it's just a focused expression of something that we really, really value. And to Alan's point, like sort of governance, and there's all sorts of, modern theories around, how to oversee and govern corporations, and this seems endless in terms of new ideas. We're kind of attracted to the old-fashioned idea of proprietorial management structures, and so anyway,
No, great.
Lots of ways to make money.
Yeah, that's great. Thank you very much. This is quite a quick question. You mentioned the Brunswick Fund had about 50% in family and founder-led companies. How much is in the broader Australian equity fund?
Australia, I don't have the exact statistic, but it'd be probably, more like 10-15%, if that actually. Being sort of top 100 centric, there'd be companies like Xero and News Corp and a couple of others. Reese is in our big cap fund now. But it's just, the structure of the Australian marketplace is, it's a very institutionalized market. And so there's the other two categories that referred to, the owner-operated cultures and the specialist, focused management teams, which would dominate the scene. There's be companies like, CSL and Macquarie Bank in that really strong owner-operated culture. So Australia is actually, almost, described as an other people's money market. There's lots of really great companies in that mid-cap, small-cap area that would fit into that founder orientated space. But we're a very institutionalized market, particularly in the big caps.
Thank you. Another one, the concept of family and founders is quite unique. How do you come across these businesses, as many of the ones that you have in your portfolio would be considered quite unique on a listed basis? So how do you actually filter for them?
It is really, it's been nearly 15 years of wearing out the shoe leather, doing 1,000 one-on-one visits with management as a team every year. And it's almost we have a strong affinity for companies that quietly go about their business. So Midwest US or some of the southern parts, the Nordics in Europe, they've been really great hunting grounds and opportunity sets for us. They're a bit under the radar, great niche businesses, big opportunities to keep expanding markets. And so when you build the networks, it just keeps kind of rolling from there. In St. Paul is a 30-minute drive from Minneapolis, and I'll never forget where one executive said, we turned up, we've come all the way from Melbourne, and he said, what anytime you want, just come through. And so we met him, and he said, thanks for coming. Look, Minneapolis, it's half-hour drive, big asset management industry, but they still want me to go to them. They won't even come here, and we're making the effort as long-only investors to go see them in their headquarters, in their offices. And so building those relationships with the people running their company, and spending the time to get to know their businesses, get to know them, is the key start of the idea generation process. Because, as I said, that we can just follow that. Danaher example is a great one, where 5% of their business was this industrial business, industrial printing. Think of use by dates on a Coke can. They'd make the printers, they'd sell the ink. It's quite a nuanced thing. You've got to be part of the packaging process. It was 5% of the company, but they just kept telling us about it and telling us how good it was. And so it was obviously a great business inside there. It was just small. And we did our follow-on work, and the number two was a UK peer out in Cambridge in UK. So we met with them, spoke with them, and that ended up being a great investment, as we bought them, and they ended up getting taken over by the Japanese company Brother about 18 months later. So listening and watching and being pointed in the direction by our companies is a really important part of how we get ideas.
Thank you. One last one from me. One of your slides showed a cartoon of a son applying for a job to his father, and you must come across these family breakdowns or friction. How do you control for that? And how do you, what's the thought process when you encounter that? Yeah.
Marcus, have we had any families break down while I've been owning? I can't think of the
I don't
breakdown.
think so. We've had a few successful ones where the father's there and the sons have other prominent roles, but no breakdowns.
I think we
But I guess
try
it's
to
important to
avoid
meet. Yeah, I mean, certainly we're trying to avoid it, and I suppose in the instance where the family has several people or several generations in important roles, we definitely make the effort to sort of meet them and understand them and their motivations. Often with these multi-generational family-led businesses, the family has significant board exposure, seats and ownership, and perhaps one or two key executives. But yeah, if they were littered throughout the company with a bit of nepotism seeping through, that's probably cause for a bit more caution.
Great, thank you very much. And one last one, just from an attendee, they've asked, are there many Asian or Japanese companies in the Family Founders Fund?
So of the 20 stocks we own, 2 of them are from Asia. And we have our own Asian fund as well that has a large component of these types of companies. So it's on our watch list. It's part of the portfolio, but it's that's one where it's the pitfalls you've got to be wary of in certain markets. But when it works well given the growth dynamics. So yeah, it's like with anything else, it's part of the process.
Great, thank you very much. It's all the time we have for questions today. So I'd like to thank Peter, Allan and Marcus for their time, and everybody for listening at home. I hope you've gained some valuable insights into Cooper Investors and the Family and Founders Fund. If you have any more questions or would like more information, don't hesitate to ask, and we'll be happy to help. So we'll be sending invites out for our next fund manager webinar in the new year, so keep an eye out for that. But yeah, once again, I'd just like to thank Peter, Allan and Marcus once again for your time today, and I hope everyone has an enjoyable day. So thank you.
Have a great Christmas, Kane. Thank you.
Thank you.
Thanks,
Thank
Kane.
you.
Thanks for organising. Thank you.
Thanks.
Thanks, everyone.